The whole system is going to collapse, and none of us own enough cash.
Man, that's a terrifying thought.
Right.
Yeah, I mean, it is certainly not the kind of sentiment you expect to hear on a typical, Tuesday morning while you're just sipping your coffee.
No, not at all. I mean, you would think that's a line pulled straight from some dystopian sci-fi script.
Well, absolutely.
Or maybe like the opening monologue of a doomsday prepper's YouTube channel. But, here's the reality for you listening right now. That isn't fiction.
It's really not.
No, that is the exact unvarnished thesis that we are unpacking in today's deep dive.
And it's a heavy one.
It really is.
Yeah.
So we are looking at this highly detailed, frankly jarring interview with macroeconomic forecaster Tavi Costa. He's the co-founder of Azura Capital. And our mission today is to cut straight through the financial noise that just constantly surrounds us.
Right, because there's a lot of it right now.
Tons of it. Because right now, the disconnect between the mainstream narrative and what these top macro forecasters are actually doing with their capital, I mean, it's staggering.
It is. The divergence is genuinely unprecedented right now. I mean, if you consume traditional financial media today, the narrative is practically, engineered to be comforting.
Oh, totally. Everything is fine. Right?
Exactly. The prevailing story is that inflation has finally cooled off, and the Federal Reserve has, orchestrated this flawless, painless economic landing.
The famous soft landing.
Right, the soft landing. And on top of that artificial intelligence stocks are just going to act as this perpetual motion machine for the S&P 500.
Just going up forever.
Yeah, just up and to the right.
Yeah.
But Costa is operating in a completely different reality.
Yeah, he really is.
And the fascinating part is he is looking at the exact same macroeconomic data points as everyone else. But he is running the precise opposite playbook.
Which is exactly why we need to pull this apart today.
Yeah.
Because, I mean, as someone who naturally leans toward a traditional 60-40 portfolio mentality.
Sure, most people do.
Right. I see the market hitting all-time highs and I think, okay, well, system is working. My retirement account looks good.
It's a natural reaction.
But Costa is out here warning about this historic slow-motion collision. I mean, he's pointing to a trifecta of systemic risks. You've got compounding sovereign debt, runaway government spending, and this incredibly fragile monetary foundation.
Yeah, it's a toxic mix.
It really is. And to survive what he sees coming, he claims the smartest capital in the room is just rapidly abandoning traditional safe havens. They're flooding into tangible, hard assets.
And to really understand the mechanics of his strategy, we first have to deconstruct the foundation of his argument.
Okay, where do we start?
Well, it revolves around what he calls the inflation illusion.
The inflation illusion.
Yeah. So the mainstream consensus, which relies heavily on government reports like the CPI, the Consumer Price Index, or the Producer Price Index, that consensus suggests the inflation dragon has basically been slain.
We beat it.
Right, we won. You even hear prominent figures like former Fed Governor Kevin Walsh referencing indices like Truflation.
Oh, I've heard of that one.
Yeah, and they assert that long-term inflation is a purely monetary phenomenon that the central bank now has under strict control. But Costa vehemently disagrees with this.
He's not buying it at all.
Not even a little. He argues that real-world inflation is running significantly hotter than any official report is willing to admit.
But wait, how can that be? I mean, the Bureau of Labor Statistics publishes the CPI every single month. It's a mathematical index, right?
Right.
Wall Street trades entirely based on those decimals. Are you saying Costa believes the data is just completely fabricated, like they're just making it up?
Well, no, he isn't saying they're making numbers up out of thin air.
Okay.
But he is highlighting the fundamental flaws and really the mechanical manipulation of the methodology itself.
Manipulation how?
So, over the decades, the way governments calculate inflation has been repeatedly altered, and almost always to suppress the official number.
Huh. Give me an example.
Okay, take the concept of substitution, for example.
Substitution, okay.
Right. So, say the price of steak goes up 20%. The index methodology assumes that consumers will simply swap out steak for hamburger.
Oh, I see.
Yeah. So instead of registering that massive 20% spike in beef, the index registers a much smaller increase because it actually swapped the underlying good they're tracking.
Wow. So they're essentially changing the rules of the game while it's actively being played.
Exactly.
If you can't afford the lifestyle you had 5 years ago, the data just assumes you've downgraded your lifestyle, and they call that price stability.
That's exactly it. You hit the nail on the head. And then you also have these things called hedonic quality adjustments.
Hedonic what?
Hedonic quality adjustments. So let's say new car costs 10% more this year than last year, but it has, a better infotainment screen or improved safety features. The government might adjust that price increase downward in the official data
Wait, why?
because they argue you are getting more value for your money. The car is better, so it's technically not just inflation.
But you can't pay for your groceries with hedonic adjustment.
Exactly.
Yeah.
You still have to finance that larger car loan. The cash is still leaving your bank account.
That's wild.
It is. And furthermore, look at how housing is calculated. They use this thing called owner's equivalent rent.
Which is what exactly?
It's basically a survey. They ask homeowners what they think they could rent their house for.
You're kidding. They just ask them.
Yep. Rather than tracking actual real-time housing costs and interest rates and mortgages,
That seems so subjective.
it's incredibly subjective. So Costa's point is that if you operate a business, or honestly, if you just walk into a grocery store, the raw cost of goods, services, and labor is at a level that makes the official reported data look entirely disconnected from physical reality.
Okay, I understand the critique of the data now. That makes a lot of sense. But even if inflation is running hotter than reported, the U.S. economy is still technically growing, right?
Sure.
Costa himself notes in the source material that the U.S. is trying to maintain a GDP growth rate of like 4 to 5%. Isn't that enough to outpace this real-world inflation?
See, that 4 to 5% growth target is actually the most precarious part of the whole equation.
Really? Why?
Because Costa points out that the United States is attempting to grow the economy at that rate exclusively to generate enough tax revenue to service its debt.
Just to pay the interest.
Yes. The growth isn't creating some massive surplus for new projects. It is a desperate sprint just to stay in the exact same place.
Wow.
And this brings us to the epicenter of the systemic risk he's warning about, which is the United States Treasury market.
The Treasury market, which, I mean, that's supposed to be the bedrock of everything.
It's the foundation of global finance.
Right. It's the risk-free rate. It's the collateral that underpins literally every central bank and sovereign wealth fund on Earth.
It is supposed to be. But Costa observes that the Treasury market is currently exhibiting volatility profiles that you would typically associate with emerging market debt.
Like third world country debt.
Yeah, it's behaving erratically.
Yeah.
And the reason for this volatility is the sheer staggering volume of debt that must be managed right now.
How much are we talking?
Well, according to the interview, somewhere between 25 to 33% of all outstanding U.S. sovereign debt needs to be rolled over within the next 12 months.
Oh my God, that is a staggering figure.
It's massive.
A third of the national debt coming due in a single year. I mean, to put that in perspective for you listening, this isn't like paying off a 30-year fixed mortgage where your payment stays the exact same every month.
No, not at all.
The U.S. government is operating more like a homeowner who bought a multi-million-dollar mansion using an adjustable rate mortgage. And right now, a third of that massive loan is about to reset to today's market interest rates.
That is a highly accurate mechanical comparison. And the timing of this reset is just catastrophic.
Because rates are so high now.
Exactly. Over the past decade, the government borrowed trillions at near 0% interest. Money was essentially free.
Right.
Now that debt is maturing, and they have to issue brand new bonds to pay off the old ones. Except now the prevailing interest rates are dramatically higher. The source material references a recent interest rate regime around 3.75%.
Which is a huge jump from zero.
Huge. And Costa argues the current system can barely sustain even that 3.75% level.
Okay, I have to play devil's advocate here for a second.
Go for it.
Jerome Powell and the Federal Reserve, they have been crystal clear in their press conferences. They say they are data dependent.
Right.
If this real-world inflation Costa is talking about starts showing up undeniably in the data, textbook economics says the Fed has to hike rates to crush it. I mean, they did it in the 1980s under Paul Volcker.
They did.
So why is Costa so absolutely certain the Fed will just roll over and accommodate inflation instead of fighting it like Volcker did?
Because of this concept called fiscal dominance.
Fiscal dominance.
Yeah. In the 1980s, when Volcker was in charge, the U.S. debt-to-GDP ratio was roughly 30%.
Okay. And today?
Today, it is over 120%.
Oh, wow.
Yeah. The mathematics of the situation simply supersede textbook monetary policy. If the Federal Reserve were to truly combat the level of real inflation Costa is observing—
Which would require what, like massive rate hikes?
Yeah, which might require hiking rates to 8%, 10%, or even 15%.
Right.
If they did that, the interest payments on that newly rolled over debt would instantly consume the entire federal budget.
So if we look at the federal budget as a pie chart, the slice labeled interest on the debt would just literally eat the rest of the pie.
Exactly. It would consume everything. If they hike rates to combat inflation, there would literally be zero capital left for defense, infrastructure, Medicare, or federal salaries.
The government would shut down.
The government would technically default. Therefore, Costa concludes that the Federal Reserve is fundamentally trapped.
They have no move.
Right. The path of least resistance is not to hike rates and trigger a deflationary depression and a sovereign default.
Because that's political suicide.
It is. So the path of least resistance is to quietly inflate the debt away.
Inflating the debt away. Okay, let's break down exactly how that works mechanically. For the listener, what does that actually look like?
It is a process called financial repression.
Financial repression.
Yeah. The central bank will have to tolerate inflation running at, say, 5% or 6% in the real economy,
Okay.
while artificially capping the interest rates on government bonds at maybe 3 or 4%.
Ah, I see.
This creates deeply negative real interest rates. Over a decade, the purchasing power of the currency halves, which means the government is paying back its fixed trillion-dollar debts with dollars that are only worth 50 cents.
Wow. So they're basically inflating away their own obligations.
Exactly. It is a slow, unlegislated tax on the purchasing power of every single citizen and institution holding cash or fixed income assets.
Which means the money sitting in your checking account right now is guaranteed to lose its value by design.
By design.
It is the only mathematical way out for the Treasury.
It is.
And this mechanism of devaluation, it isn't just a domestic issue, right? It bleeds directly into the global standing of the U.S. dollar.
Oh, heavily.
Because the source material dives deep into America's twin deficits and how they virtually guarantee a decline in the dollar's strength. Let's talk about that.
Yeah, so a twin deficit occurs when a nation is simultaneously running a fiscal deficit, meaning the government spends way more than it takes in through taxation.
Which we definitely do.
Right. And a current account, or trade deficit, meaning the country imports far more goods and services from the rest of the world than it exports.
Also us.
Yes. Costa notes the U.S. is running these twin deficits in the double digits relative to GDP.
So to bring this down to a corporate level, it is as if Apple was operating at a massive loss on its internal budget, while simultaneously buying all its iPhone components from competitors without ever selling any phones back to them.
That's a great way to look at it.
You are just hemorrhaging capital on all fronts.
Precisely. You're bleeding out. Now, if you look at a chart of the DXY, which is the U.S. dollar index, it measures the dollar against a basket of other major fiat currencies.
Right, the euro, the yen, all that.
Yeah. If you look at that, the dollar has actually appeared quite strong recently.
It has.
But Costa views this strength as a structural anomaly that just has to break.
Why does it have to break?
Well, the mechanics of global trade dictate that when you run a massive trade deficit, you are flooding the world with your currency to buy their goods.
Because we have to pay them in dollars.
Right. Eventually, foreign nations and their central banks accumulate way too many dollars in U.S. treasuries. When they stop aggressively buying that debt, the only way to rebalance the trade deficit is for the domestic currency to devalue.
Because a devalued dollar suddenly makes American manufacturing and export significantly cheaper for foreign buyers, right?
Exactly.
It stimulates foreign demand for U.S. goods to close that gap.
Correct. And on top of that, the global financial system, which is heavily dollarized, actually chokes when the dollar is too strong.
Oh, right. Emerging markets.
Yes. Emerging market countries that have borrowed in U.S. dollars face crushing repayment burdens when the dollar spikes. Their local currency buys fewer dollars, so their debt gets heavier.
That makes sense.
So for the global economy to continue functioning, and for the U.S. to manage its twin deficits, a structurally weaker dollar is just a mathematical necessity.
But surely, I mean, America's technological supremacy protects the dollar to some degree, doesn't it?
You would think so.
Because Costa points out that the U.S. has enjoyed incredible absolute advantages for decades. We have strict rule of law, we have the deepest capital markets in the world, and an undeniable leadership position in technology, specifically artificial intelligence right now.
Sure.
We act as this massive magnet for the best engineering and financial minds on the planet. Doesn't that justify a strong dollar and the premium valuations we see on U.S. tech stocks?
Well, it has historically justified a premium, yes.
Mm-hmm.
But Costa argues that the gap between the absolute advantage of the U.S. and the rest of the world is actively shrinking.
Shrinking.
Yeah, it's shrinking, while the valuation gap in the stock market is expanding vertically. And AI is actually the perfect example of this.
How so?
You mentioned U.S. leadership in AI development, which is true. We are building the models. However, AI as a deployable tool is the ultimate great leveler. It dramatically lowers the barrier to entry for productivity globally.
Walk me through that. What does that mean for the labor market?
Okay, so imagine you were an engineering firm in a developing nation. Historically, you were severely constrained by the lack of highly educated, specialized human capital compared to somewhere like Silicon Valley.
Right, the talent pool was just smaller.
Exactly. But today, the deployment of advanced AI models allows smaller, less specialized teams anywhere in the world to produce code, analyze data, and optimize supply chains at a level that previously required a massive concentration of elite talent.
Oh, wow. So they can just leapfrog the traditional education bottlenecks.
Yes, AI reduces the absolute advantage of the U.S. labor market
Yeah.
because it allows the rest of the world to rapidly catch up in efficiency. So you have a shrinking competitive gap paired with a currency that structurally must devalue to service its massive debt.
So if the US dollar has to weaken, and US equities, specifically tech stocks, are priced for absolute perfection despite this shrinking competitive moat, the smart institutional money has to move.
It has to.
It cannot stay trapped in assets that are mathematically guaranteed to lose real purchasing power. So if capital is fleeing the overvalued US tech sector, where exactly is the escape hatch? Where is Costa looking?
Well, when institutional capital realizes the structural math is broken, when they see promises of fiscal discipline fail entirely, they seek out deeply undervalued regions that produce what the world actually requires to function.
Raw materials.
Right. And according to Costa, over the next 5 to 10 years, that capital is going to trigger a massive renaissance in Latin America.
Latin America. Now, I have to stop and contextualize this for you listening, because when traditional investors hear Latin America, they almost always think of political instability.
Oh, without a doubt. It's the first thing that comes to mind.
Right. The source material notes Argentina has historically battled inflation rates north of 30%, 50%, or even higher. We've obviously seen hyperinflation in Venezuela. How can a macroeconomic forecaster look at that region and see a safe haven for global capital?
Because it is entirely about understanding the philosophy of net change investing.
Net change.
Yes. Institutional capital does not wait for a region to become a utopian, perfectly stable market before deploying funds.
Because by then it's too late.
Exactly. If they waited for perfection, the asset prices would already be fully valued and the excess return would be zero. Capital cares about the trajectory.
So it is similar to real estate investing in a major city.
How do you mean?
Well, you don't make generational returns buying a pristine, fully renovated brownstone in the most expensive neighborhood.
Right, the price is already baked in.
Exactly. You make the returns by identifying a dilapidated neighborhood where the city has just approved a massive new transit hub and new rezoning laws. You are buying the trajectory of gentrification. The plumbing in the house might still be terrible today, but the fundamentals of the neighborhood are rapidly turning positive.
That is exactly how macro capital views emerging markets. That's a perfect analogy. The absolute conditions might still look messy to a retail investor, but the net change is aggressively positive. And Costa notes a profound institutional shift occurring across Latin America toward market-friendly capitalist policies.
Now, before we dig into the specifics of those policies, we need to explicitly state something for our audience.
Yeah, please do.
In analyzing Costa's thesis on these regional shifts, we are looking purely at the mechanics of capital flows. When we discuss a shift toward capitalism or specific regulatory changes in these nations, we are objectively evaluating how global markets react to those frameworks.
Right.
We are not endorsing any specific political ideology, party, or regime. Our mission today is just to trace the money exactly as outlined in the source material.
Understood. And it's a very crucial distinction to make. Capital is entirely agnostic. It simply flows to where it is treated best. And right now, Latin America is implementing frameworks that attract that capital.
What kind of framework?
Well, for instance, we are seeing stronger central bank independence in countries like Brazil. They aggressively hiked rates to fight inflation long before the U.S. Federal Reserve even admitted inflation was a problem.
Oh, wow. So they were actually ahead of the curve.
They were. And we are seeing more stable mining codes in places like Peru. Over the past 5 years, the currencies of Mexico, Peru, and Brazil have vastly outperformed developed market fiat currencies.
And the region is essentially the global vault for the strategic natural resources the world is suddenly desperate for.
Exactly. Latin America is arguably the most resource-dense, yet underexplored region on the planet. And compared to other resource-heavy continents like Africa, it possesses a much more established legal and institutional framework for foreign direct investment.
So the roads, the ports, the laws, they're already functional.
Right. The infrastructure to extract and export is already largely in place. The source material references a really compelling chart from Bank of America indicating that emerging markets are currently breaking out into a secular bull phase relative to the S&P 500.
So this isn't a flash in the pan.
No, this isn't a short-term trade. This is a decade-long cyclical rotation of global market leadership.
The interconnectivity of these Latin American economies to raw materials is just fascinating to me. Costa brings up this quirk about investing in Chile that honestly blew my mind when I read it.
Oh, the ETF thing.
Yes. So if a portfolio manager wants exposure to the Chilean economy, they typically buy the primary exchange-traded fund, ticker symbol ECH.
Right. And you would assume a broad country ETF holds a diversified basket of, banks, tech companies, retail, manufacturing.
But it doesn't. The ETF holds almost no direct mining companies. Yet, because Chile controls such a massive percentage of the global copper supply, the entire national economy is effectively a derivative of the copper price.
It's all connected.
It is. If the price of copper surges on the global market, Chilean banks write more loans, retail spending in Santiago explodes, and the entire ECH ETF skyrockets.
Yeah.
The country's economic pulse is entirely tethered to a single hard asset, which naturally leads us to the asset itself, copper. Because copper is undergoing this unprecedented identity shift on the global stage.
It really is. Historically, copper has been viewed as a highly cyclical industrial commodity. In financial circles, it is often called Dr. Copper.
Dr. Copper.
Yeah, because it is said to have a PhD in economics.
Ah, I love that.
Its price action has traditionally been a very reliable barometer for the health of the global economy. When China or the U.S. was building infrastructure and expanding credit, copper prices rose.
Because they needed it for pipes and wires.
Exactly. When recessions hit, construction halted and copper plummeted. It was highly correlated to the ebb and flow of global growth.
But Costa points out that copper is breaking that historical mold. It is actively decoupling from its traditional economic correlations and is currently trading much more in line with the S&P 500.
Which is wild.
It is. He quotes billionaire mining financier Robert Friedland, who makes a statement that sounds almost absurd at first glance. Friedland calls copper the new safe haven.
A safe haven.
Right, a base industrial metal as a safe haven. That completely challenges traditional financial orthodoxy. We're taught gold is the safe haven, or treasuries, not copper.
It challenges orthodoxy until you really examine the underlying physics and the structural supply-demand imbalance driving the market today.
Okay, break that down for us.
Copper is no longer just a cyclical building material. It is the absolute bottleneck for the next industrial revolution. The demand side of the equation is experiencing a multi-front explosion that is entirely structural.
Meaning it's not going away even in a recession.
Exactly. It isn't dependent on a temporary economic boom.
We are talking about the AI data centers, the onshoring of manufacturing, and the electrification of the grid. But let's look at the how here. Why does an AI software boom require so much physical metal?
It comes down to power, density, and thermal management.
Heat.
Heat, yeah. The GPUs, those graphic processing units required to train and run large language models, they consume an exorbitant amount of electricity compared to traditional data center servers.
They run super hot.
Insanely hot. When you run thousands of these chips in a concentrated facility, they generate immense heat. Traditional air cooling just no longer works.
You can't just put a big fan in the room.
No, you'd melt the servers.
Yeah.
These facilities are transitioning to liquid cooling architectures, massive heat exchangers, and entirely upgraded internal power distribution networks. And all of these require staggering tonnages of high-grade copper.
Wow.
Furthermore, the local power grids supplying these data centers have to be completely overhauled with new transformers and transmission lines, which again are heavily dependent on copper.
So you have this voracious, price-insensitive demand from the tech sector. They just have to have it, whatever the cost.
Right.
What does the supply side look like?
The supply side is structurally constrained. You cannot simply flip a switch and produce more copper.
Why not just dig another hole?
Right, if only it were that easy. It takes between 10 to 15 years of permitting, environmental reviews, and billion-dollar capital expenditures to bring a new Tier 1 copper mine into production.
15 years.
Yes. And the existing major mines globally are aging. Plus, the ore grades, which is the percentage of actual copper found in the rock, are steadily declining.
Meaning the rocks are getting lower quality.
Yes, we are pulling less copper out of the ground for every ton of dirt we move.
This creates an incredible tension in the market. Costa uses a fantastic mechanical analogy to describe how copper is trading right now under these conditions. He says looking at the price action of copper is like watching a coiled spring being compressed into a rapidly shrinking box.
It's a great visual.
It is. The macroeconomic pressures, high interest rates, a strong dollar have been pushing down on the price, but the structural physical shortage is pushing back with relentless force.
And historical precedent tells us how this resolves. When commodity with a severe structural deficit finally breaks past its prior all-time highs, it rarely just inches up by 5 or 10%.
It doesn't just creep up.
No. Once it enters true price discovery, where there is no historical overhead resistance, the moves are violent. Costa likens it to silver's historical breakout.
What happened there?
For years, silver was suppressed, but when it finally broke out of its trading range, it exploded from $40 up to $120.
Wow.
We saw a similar dynamic when gold decisively broke the $2,000 an ounce barrier and rapidly spiked to over $5,000. Copper is coiled for a similar revaluation.
Which introduces a completely new geopolitical dynamic. If copper is the absolute bottleneck for AI dominance and grid security, it is no longer just an industrial input. It becomes a matter of national security.
Exactly. Think about the United States Strategic Petroleum Reserve.
Right.
In the 1970s, after the oil embargoes, the government realized that relying on just-in-time delivery for a critical energy resource was a fatal vulnerability.
So they hoarded it?
Yeah, they hollowed out salt caverns in the Gulf Coast and stockpiled millions of barrels of crude oil to ensure the nation could survive a supply shock.
And Costa suggests we are seeing the early stages of governments applying that exact same logic to copper. Sovereign nations and central banks are beginning to view physical copper inventories not as commercial commodities, but as strategic stockpiles necessary to guarantee their participation in the AI-driven economy of the 21st century.
If you don't have it, you can't build.
Right. If you do not possess the physical metal, you cannot build the data centers. You basically forfeit the technological arms race.
So while copper represents the critical infrastructure of our future, if we want to understand the ultimate barometer of our failing monetary system, we have to examine the asset that has served as a safe haven for 5,000 years.
Gold.
Gold!
Gold is such a fascinating psychological asset. Earlier in the year, the source material notes gold went on an absolute tear, breaking through historical resistance and skyrocketing above $5,000 troy ounce.
It was front-page news everywhere.
It was, but since then, it has experienced a sharp 25% correction, settling back down just below $4,000 an ounce. And predictably, a lot of retail investors just panicked.
They always do.
They saw the drop, assumed the thesis was dead, and ran for the exits.
But Costa views that 25% correction not as a failure, but as a mathematical necessity within a much larger secular bull market. To understand his conviction, you have to look at gold not as a simple trade, but as the ultimate anchor for sovereign debt.
He draws a highly illustrative parallel to the financial architecture of the 1940s to explain this, right?
He does,
Yeah.
and it's a brilliant comparison.
Right, because coming out of World War II, the United States had amassed a colossal amount of debt relative to its GDP, very similar to the debt-to-GDP ratios we are staring down today.
The debt burden was massive, but the monetary foundation was fundamentally different back then.
How so?
In the 1940s, approximately 50% of the entire U.S. Treasury market was implicitly backed by the gold reserves held by the government.
Half of it.
Half. The debt was immense, sure, but the collateral was equally robust. The system had an anchor.
Contrast that with today. The debt-to-GDP ratio is arguably worse. The structural deficits are compounding. Yet Costa points out that today, only roughly 3% of the U.S. Treasury market is backed by gold.
It is an extreme, highly unstable imbalance. The foundation holding up the global collateral system is precariously thin.
3% versus 50%.
Right. For the system to find any semblance of equilibrium, one of two things must happen. Either sovereign institutions must aggressively accumulate vast amounts of physical gold to increase their reserves,
Which would drive the price up.
or the price of the gold they currently hold must be revalued astronomically higher to cover the expanded debt load.
Or both.
Exactly. The reality is both are likely occurring simultaneously.
I want to touch on a fundamental debate about gold that always comes up. The traditional finance guys, the tech investors, they often just dismiss gold. They call it a shiny rock or a pet rock that generates no yield, has no earnings, and serves no real purpose in a modern digital economy.
You hear that all the time.
Why is Costa so adamant that it remains the premier monetary asset?
Well, it is crucial to understand why gold became money in the first place.
Right.
It wasn't an arbitrary decision.
Right.
Gold became the universal standard precisely because it is arguably the most fundamentally useful, durable, and chemically stable element on the periodic table.
It doesn't rust or tarnish?
It doesn't corrode, it conducts electricity flawlessly, it is infinitely malleable, it has incredible industrial utility. But Costa highlights a profound paradox here.
What's the paradox?
Gold became so universally desired as a reliable store of value that its price was driven exponentially higher.
It graduated.
Exactly. Its monetary premium made it far too expensive to be utilized in everyday industrial applications. Industry had to find cheaper substitutes, like copper or silver, because locking up thousands of dollars of gold in a disposable circuit board was just economically unviable.
So its utility made it valuable, but its value pushed it out of utility.
Right. Gold's sheer utility is what elevated it out of the industrial supply chain and into the central bank vaults as the ultimate incorruptible monetary reserve.
Which brings us to what Costa identifies as perhaps the most bizarre generational disconnect in the financial markets today. The price of the metal itself, gold, is sitting just below $4,000 an ounce. Even after the correction, that is an incredibly high, highly lucrative price for anyone pulling it out of the ground.
Oh, massively lucrative.
Yet, the companies that actually mine the gold are being priced by Wall Street as if the industry is on the verge of bankruptcy.
The dislocation between the commodity and the equities is staggering. Costa looks at the senior established mining producers. The source material specifically mentions Agnico Eagle as an example.
Right.
These are massive, well-capitalized operations. Their product is selling for nearly $4,000 an ounce, meaning their margins are expanding, and they are generating phenomenal amounts of free cash flow.
They are printing money.
Literally.
Yeah.
Yet their stock prices have plummeted 40 to 44% from their peaks.
How is that mechanically possible? I mean, if a company's product doubles in price and their extraction costs haven't doubled, their stock should theoretically soar.
It comes down to market psychology and algorithmic trading. Wall Street has completely abandoned the mining sector in favor of the tech and AI narratives.
Everyone wants NVIDIA, nobody wants a gold mine.
Precisely. Costa notes that these senior miners are currently trading at a severe discount to their net asset value, or NAV.
Let's define NAV for the listener.
Okay, net asset value is essentially the liquidation value of the company. If you took all the proven gold reserves in the ground owned by the company, multiplied it by the current price of gold, and subtracted all their debts and liabilities, that is the NAV.
Basically what the company is actually worth in parts.
Yes. Costa is pointing out that these companies are trading at a price to NAV multiple that implies the market believes gold is actually sitting below $3,000 an ounce.
Even though it's near 4,000.
Yes. The stock market is aggressively discounting reality.
So, as an investor, you face a critical psychological test. You see a senior gold miner drop 40%. The instinct for most people is panic. You assume the market knows something you don't. You sell your position, and you retreat to cash.
It's human nature.
But Costa's methodology requires you to pause and ask one question. Has the fundamental macroeconomic thesis changed? Has the U.S. resolved its twin deficits? Has the debt magically vanished? Has the Federal Reserve found a way to hike rates to 10% without collapsing the Treasury market?
And since the answer to all those questions is a resounding no, Costa views this disconnect not as a reason to panic, but as a generational opportunity to aggressively accumulate high-quality assets at a massive, irrational discount.
And he utilizes very specific intramarket indicators to confirm that his thesis remains intact, despite the price drops, right?
He does.
Right? He looks at the relationship between the junior miners and the senior miners.
Yes. In the mining ecosystem, you have the seniors, which are the massive companies actively pulling millions of ounces out of the ground.
The big boys.
Right. Then you have the juniors, which are essentially exploration companies. They are highly speculative, risk-on ventures searching for new deposits. They are the riskiest asset class within the sector.
So logic would dictate that in a brutal 40% market pullback, the riskiest, most speculative assets, the juniors, would get completely annihilated. They should perform far worse than the established seniors.
Exactly. But Costa observes the precise opposite occurring. In this current market environment, the junior explorers are actually demonstrating remarkable resilience.
Really?
Yeah, in many cases, they are outperforming the senior producers and sometimes even outperforming the price of physical gold itself.
Why does that matter? What does that signal mechanically?
It is a textbook diagnostic indicator of market health. When the smartest institutional capital in a sector is willing to maintain exposure to the highest risk, most speculative tier of that sector during a sharp correction, it signals something huge.
What does it signal?
It signals that the underlying confidence in the long-term trend remains unbroken. It tells you that this isn't the end of the gold cycle, where capital flees entirely. It indicates we are likely in the middle, or perhaps even the very early stages, of a massive secular bull market.
Because they're still betting on the risky stuff.
Yes. The smart money is holding the risky assets because they know the structural math guarantees a higher gold price in the long run.
That discipline, the ability to identify a structural trend, trust the math, and aggressively buy when the market irrationally discounts high-quality assets, that is the core of Costa's playbook. And this philosophy doesn't end with metals. It extends directly into the energy markets.
It does. And this brings us to a masterclass in cyclical capital rotation. The fatal flaw of many investors is that they fall in love with an asset class.
Oh, people get tribal about it.
Very tribal. They identify as gold bugs or tech bros, and they hold those assets regardless of valuation. Costa is brutally unsentimental. He strictly obeys the risk-to-reward ratio as prices fluctuate.
The source provides a brilliant timeline of this discipline. About 8 or 9 months prior to this interview, Costa was heavily invested in the energy sector. He recognized the structural underinvestment in oil and gas. And his thesis proved correct. Oil prices surged, eventually crossing the $100 a barrel threshold.
But when oil crossed $100, the risk-to-reward ratio shifted. The easy money had been made, and the risk of a cyclical pullback increased. So he didn't ride the momentum blindly.
What did he do?
He systematically liquidated a significant portion of his energy portfolio. He took those profits and rotated the capital directly into copper, which at that specific time was deeply unloved and trading at a substantial discount.
He sold the expensive asset to buy the cheap, essential asset.
Exactly.
And now the cycle has turned again. With oil prices having corrected back down to around $80 a barrel, what is Costa doing? He is executing the exact same rotation in reverse. He views $80 crude oil as highly attractive, especially when utilized as a strategic counterbalance to a portfolio that is heavily concentrated in precious metals. He is actively deploying capital back into oil exploration, natural gas infrastructure, and the specialized service businesses that support energy extraction.
But I want to emphasize the scale at which Costa operates here. He isn't just logging into a brokerage app on his phone and buying a few shares of an Exxon ETF.
No, not at all.
The source notes that he is currently in the process of forming an entirely new private energy company from scratch to capitalize on these specific valuations.
It is a profound demonstration of conviction. And this isn't theoretical for him. He has a track record of this exact execution.
Oh, with the silver mine, right?
Yeah. The source mentions that 5 years ago, recognizing a similar structural deficit in the silver market, he didn't just buy silver futures on a screen. He formed an entity and physically acquired the 4th largest silver mine in the world. That is the difference between playing the market and understanding the macroeconomic reality. He takes these incredibly complex abstract theories about sovereign debt rollover, fiscal dominance, and currency devaluation, and he translates them into tangible, boots-on-the-ground business execution.
It's incredible to watch.
When you truly believe the fiat currency system is trapped, you don't just trade paper derivatives. You buy the literal hole in the ground that produces the physical asset.
Exactly. You secure the actual resources that the global economy requires to function.
We have covered an immense amount of ground today, and it is crucial we tie all these mechanical threads together. We began by dismantling the illusion of government inflation data, revealing how hedonics and substitution mask a reality where the Federal Reserve is mathematically trapped.
They're stuck.
They cannot hike rates to 10% to fight inflation without instantly collapsing the Treasury market through insurmountable interest payments.
Which forces a reality of fiscal dominance. The only viable exit strategy for the sovereign debt is financial repression.
Intentionally holding interest rates below the real rate of inflation.
Right, to quietly devalue the debt burden.
This inescapable requirement for devaluation, compounded by double-digit twin deficits, structurally guarantees a weaker U.S. dollar. And as the absolute advantage of U.S. technological supremacy is leveled by tools like AI, smart institutional capital is forced to seek alternatives.
That capital is flowing toward the Latin American Renaissance, drawn by a definitive shift toward market-friendly policies and an abundance of the most critical natural resources.
We explored how copper has transcended its role as a cyclical economic indicator to become a structurally scarce national security asset, vital for the AI and electrification revolutions.
And we analyzed the historical precedent of the 1940s to understand why the ultimate monetary anchor, gold, must be revalued significantly higher to balance the colossal expansion of sovereign debt.
And we saw how the market's current irrational pricing of senior mining companies trading below their liquidation value presents a generational opportunity for disciplined, unemotional capital rotators like Costa.
So, to the listener, why does diving into the mechanics of global capital flows and treasury yields actually matter to your daily life?
Yeah, why does it matter?
It matters because the path of least resistance we have outlined today is a direct mechanical assault on your purchasing power. The system is designed to quietly siphon the value of the fiat currency sitting in your savings account to subsidize the sovereign jet.
It's a hidden tax.
It is. Understanding how smart capital seeks refuge in hard assets isn't just high-level strategy for hedge fund managers acquiring silver mines. It is the fundamental blueprint you need to comprehend if you want to protect the value of your own labor in the decade ahead.
It is about recognizing the reality of the board we are playing on. Which leaves me with one final, deeply provocative thought for you to consider as we close this deep dive.
Let's hear it.
For the last 20 years, we have been relentlessly conditioned to believe that the future is entirely ethereal. We are told that software eats the world, that AI will abstract everything, and that purely digital ledgers represent the ultimate evolution of human wealth. But consider the mechanics we just discussed today. If the most sophisticated institutional money on the planet, alongside sovereign nations and central banks, are currently quietly hoarding physical gold and stockpiling physical copper just to insulate themselves from the inevitable collapse of their own debt architectures, what does that reveal about the true nature of wealth?
That's a huge question.
As we sprint headfirst into the seemingly frictionless, digital, AI-driven utopia, is it possible that the absolute most valuable, most critical, and most fiercely contested assets of the 21st century will not be lines of code, but the exact same tangible, heavy materials our ancestors pulled straight from the dirt?
Wow.
Think about the physical reality underlying the digital illusion. Until next time.